and and a little bit of volatility, which is bringing a lot of attention to the market. So Imran and we are here to talk December OPEX, and this is a more interesting OPEX than usual. Imran, how are you doing?
I'm good, man. Good to see you.
Thank you for joining me today. I know it's a little bit later. You're over there in London, obviously, and the thing that we really have to contend with right now is the World Cup, which just kicks off, I think, actually right now, Argentina.
It does kick, Argentina, Croatia, that's right.
So I think it was ill-timed on our perspective, but it's always been 2:00, so we can't shift. We'll compete with Messi. People, I think, will prefer to hear us. So if y'all can hear us, please, by the way, put them in the chat, and we will make sure. Podcast is already, this guy's been crushing it lately. So, Bob. All right, Imran. So, I don't even know where to get started, man. I feel like I've been on an adrenaline rush all day here. And the thing, I guess, that, to me, the thing coming into this that made it like such an uncomfortable position to take was that implied volatility going into this just seemed to be crazy. And there's like articles on Zero Hedge that banks are pricing it 10% moves and everybody's looking for left tail huge and VIX up huge yesterday with the market up huge yesterday. And the only edge that seemed to come was just not a directional edge, which is what generally everyone's looking for, but just a volatility edge, right? People are expecting Armageddon here in terms, or just insane 3-4 standard deviation moves. And it's maybe the edge was the volatility expectation was too crowded. Do you have kind of a take on that? I mean, now it's kind of a hindsight thing to say. But, from your chair, how did you feel about the expectations of traders coming into today?
You put it on Twitter, right? That straddle was pricing 100 points. Yeah. That's 2.5%, man. That if you look back at every CPI release for the last 6, they've all moved more than that, right? So I wouldn't say just the daily vol was overpriced, right? Now that JP Morgan guy going for 10%, if that number, I mean, that was a bit nuts. I don't think any of us really thought that was going to happen. But this price action isn't surprising. What's surprising about this price action, for anyone who's been listening to my chats with Darius or what I've been talking about, this price action isn't that surprising. It's surprising that it all happened today. I was expecting CPI comes in light, if it comes in light. I didn't know it was going to come in light, but if it comes in light, we get a 3, 4, 5% rip as per usual, right? But then we hold it until Powell, and then Powell walks the market back down. So it almost seems like the market is front running the idea that Powell doesn't like to see the market up. He's going to be hawkish if the market stays up. So we're going to smash the market up there at 41.40, which were the highs that we got to. And then we faded the whole thing back, which just shows how kind of fake the rally really was. It wasn't built on strong roots, right? It was like people were speculating for the number, want to get in and get out quickly. People had covered shorts ahead of time because they'd got their arse handed to them the time before when they hadn't covered shorts. So this morning was all about short covering, right? The way the market was rallying this morning before the number, there was a load of short covering happening there. So maybe it was one of those, right? The shorts weren't there to sustain the rally, and the guys who had become opportunistic buyers for this print were like, well, I've got the move I was looking for. Get me the hell out because I don't know what's coming next tomorrow because Powell's going to come and probably smash this rally back in my face, right? So that's kind of how I would justify the round trip. Don't know if that. What do you think of that?
I think the perception that you bring up and the idea you bring up was I was expecting CPI to be part of the move, not the whole move. And kind of in this funny way when you look at just the change of VIX, and I understand there's a bunch of different ways you want to look at vol here. You bring up an excellent point that it discharged so much of the move right away. It's CPI was the event, and it's well, no, Powell's the event, right? Tomorrow is the event. And what was the scenario for CPI that would have to happen for you to have a 5-6% rally in the market? Because Powell's speaking tomorrow. You can't really put your if your macro thesis is look, the bottom is in here, we're ready to go, and you're going to wait for the CPI number to make that decision, not Powell. So exactly to your point, it's I don't know what the scenario was that we were going to be able to sustain these 2.5–3% moves, throughout the day based on just the CPI print. Now, if Powell comes along and he cuts or pauses or substantially changes to like a much more dovish footing, then I guess then yeah, we could have a sustained rally because it's like Powell's cleared the path, like market God has spoken, and we can now move along. So your point there is like it's very perceptive, and I think it's spot on. And now it's curious if you look at the straddle. I was looking at the straddle for tomorrow, and this is still with a good hour or two left in the session today. The straddle for tomorrow is $80, so it's down quite a bit. It's not down quite as much, but I just don't know. I think other than the scenario of the CPI came in really hot, much hotter than expected, then we could have had like a pretty good move down in markets, and people would have really freaked out, and maybe that move would have stuck a little bit better. But really, it's like when the options are so expensive, I couldn't figure out the scenario where you're going to sustain that move, at least today's move, right, into tomorrow. And so it's really quite curious. So what is your view now? The VIX is at 23. Implied volatility certainly come down along a lot of ways. Tomorrow's at the money straddle was trading at about $80. How do you think now the market reacts to Powell? And now that some of the energies come out in terms of implied volatility, what's your sort of base case, or what are you looking at to try to assess how the flow is coming into tomorrow?
I think the market will still have a bit of choppiness around Powell because you've got the statement that's going to come out first, and then you got the Powell press conference, and we often get a reaction to the statement, and then often that can get reversed when they quiz Powell and he gives more details and stuff like that. So I think, again, if we got a positive reaction to the statement, then I think it would get faded in the press conference, right? I don't think it would get followed up with dovish speak from Powell, right? I don't know. It kind of feels like that 4,000 strike's in play here, right? Like I was surprised that we gravitated all the way back to it already.
Yeah.
But the big expiry, the 4,000 is correct me if I'm wrong, right? The 4,000 is the big strike. So
it is the big strike, no doubt about that.
Does that keep us kind of not too far from here until after Friday? I think it could do.
Yeah, we put this is in our morning note, and this is the spider strike that Imran's referring to. I mean, the 4,000 is big in the SPX, but it's also the 400 in the spiders, and that's this kind of neutral zone, I guess, to your point here. And I don't know what Powell's going to do. I don't even know that macro people have a great handle on what he's going to do. And so this is area 400 SPY SPX 4,000 is I think a decent base of operations. And I think the other thing that caught a lot of people off guard that was strange about this is, we had the VIX up, market up move yesterday. That was the talk of the town, and there was a lot of the bank desks were quoted as saying, yeah, everyone's actually more worried about the right tail here or explosive move up, and they don't want to miss that. And the challenge or the tricky part there is that, when you're expecting all of this movement, you're going to play into this OPEX, right, that has giant positions that are set to expire, hundreds of billions notional value set to expire. And if you look at the breakdown, and I can bring that up here, if you look at the breakdown of puts and calls in equities or in the major indices, that's right here, it's pretty balanced, meaning there's just as big call positions on from a delta perspective as put positions on. And so, a lot of times when I was talking about implied vol coming down and that capping the move, and everyone's saying, well, hold on, when you say implied vol comes down, usually you say that's a catalyst for the market to rally, right? And that's when you have these very big put positions, if you talk about October or September options expiration, when all these puts are closing and going away, and then that's rally fuel. But in this case, it seems very balanced. And there's almost this as much worry or concern about missing the left tail. And honestly, I don't hear anyone talking about the right tail at all right now. So, you have this situation where it seems like a lot of people wanted to get long gamma right into this move, or just wanted to be long options. They own these options at a very high implied volatility. And the move that you have to get, the move that has to be generated for those options to pay off is substantial. And so, we literally just let the air out of the balloon. And in this case, the balloon is it's not like on one side of the room or the other. It's like right in the middle of the room. So you let the air out there, it's just going to fall. It's not the situation where you let the air out of the balloon in such a way that it rockets up to the ceiling. Like if we had all puts and the implied vol comes out, then yeah, we could get a rally off of that as hedges are unwound. But this is much more balanced. And so I think people struggled with that idea here that because so many people are concerned about the left tail and arguably hedging for that, when the vol comes out, well, that works against a market rally in this case. What are your sort of views of that?
We talk about the Van der Charm flows get counteracted away, basically. So yeah, I agree, because basically we say is that large call position, you have to assume a fair amount of it is people buying calls rather than selling them. Whereas normally the assumption is that the calls are predominantly being sold to dealers and the puts are being bought from them. Yeah. But it does seem that because so many people have needed to hedge the right tail, it's the other way around. And therefore the charm and the vol coming lower tends to mean futures need to be sold, not bought. Well, or maybe not as many futures need to be bought as would have needed to be bought. Hence, it doesn't kind of hold the market up there, basically, right? Like it might have done previously. So totally agree with that. I think that makes a ton of sense. It's clear in the data that is the way. It's clear in the way the skew's been behaving. Skew's been offered for months, right? And people needing that upside hedge. So, yeah. I don't know. On Powell, 80 ticks for Powell is probably the right price. If I think about it, there's probably going to be a lot of noise. Probably going to be a lot of noise, but it's not a screaming buy or sell either way for me.
It feels a lot less obvious. Like I think being short, short a Strat or a Condor or whatever your weapon was, into the CPI number felt a little more obvious. Now, obviously, what was interesting was obviously that the opening gap, right, was just massive in futures. So like, the initial move was really pretty explosive and fairly accurate, actually, in terms of what the straddle price was. And obviously that that did fade very hard. You can see here that 40.50 up to 41.70, right? So that initial just ridiculous reaction. And on these reactions, liquidity in general, and you can look at this across many different metrics, liquidity in general is very poor. That's the environment that we're in. And any time that these data prints comes up, the spreads on everything just widen out, right? So if you, or whatever the headline algo that wants to get a fill is, right, that sort of instantaneous reaction is really filling into this void. And so many times this year we've gotten these humongous moves on these data points, and everyone jokes like CPI is the new FOMC, but there's no liquidity available. And so whatever the algo is that fires off into the abyss here has got to cover way more points, right, to get its fill. And I think that makes these reactions, I think people sit here and go, everyone's shocked by this, CPI reading or whatever it may be. And the fact is, like, liquidity is just bad. And so you're getting exaggerated moves to the upside and downside and all these data points just because there's no liquidity. Like the volatility is a function of crappy liquidity as opposed to shock around the actual data.
Couldn't agree more. And like you say, there's some algos reacting to that news flow that are basically getting screwed by that lack of liquidity, right? Because they're paying the wrong price.
Yeah, I mean, I've always one of the things I've always wanted to do, and maybe someone listening to this knows who has these algo bots. But what was fascinating is the move today actually happened like before the CPI reading came out.
It started to move early. Yeah, it started to move early.
Like, what the heck? But then, what is the bot? Like, how does it read the language so fast? It's like, Powell's set to speak at 2:15, and then at 2:15 exactly, suddenly, like, some algo does something. You're like, how is that? Like, what kind of language processing is this? Like, GTP3 is not this good. Like, what, they got more sophisticated stuff, but how is it possible that the reaction is that incredibly fast? It's so, it's a complete sidebar here, but it's just like, what the heck, man?
Yeah, but if your algo bought it, let's hope the algo got out of it as well, because that was a pretty brutal pullback.
I mean, it's an unbelievable pullback, and that's obviously the SPX there. Shifting back on point here, you and I are on the same page here in terms of it feels non-obvious here. And the issue is with the large options expiration is, gamma, obviously, for everyone listening knows, is highs for at the money options and near in time. So the gamma of all these options that expire. Again, it's several $100 billion in equities and in indices and the equities. All that expires on the 16th, right? So we're going to get Powell's going to trigger some kind of movement here, but there are these really big positions that vol is still relatively high. Implied vol is still relatively high due to Powell, so it's not like the show's over here. How do you think that may feed into? I mean, obviously the Fed is going to put a bullish angle or bearish angle on the market here, but how do you think about the feedback loop here of shifting from Powell on Wednesday and then day off on Thursday kind of, and then Friday we got this big OPEX? How do you think about that transition into where these big positions are?
Well, I mean, I'd say 4,000 is the strike until proven otherwise.
Yeah.
Right. And today's price action certainly suggests there may be some gravity there. Right. And then, I think implied vols are headed lower into, post. It's very high probability that implied vols are headed lower after.
Yeah.
Right. And then not just to add on top of that, we've got Christmas coming right in 2 weeks.
Yep.
So seasonality generally is for vol to get a bit crushed into that period. Now, the caveat would be if the market has a reason to melt down, but doesn't manage to melt down because the strike that holds us there. If the 4,000 strike prevents us from selling off into Friday, and yet there's a lot of sellers out there, like real sellers, but let's say not so real buyers who are just buying against expiry. Once that expiry goes and unpins, then does the market then have a catch-up move to the downside on next week? Right, that would be my potential. I think in general, the market just kind of dies a death after whatever chop there is on Powell and vols get hit. But it's just there is going to be that risk that if there is a good enough reason to be selling risk assets and the market isn't allowed to sell off because of the pin, then we may get that move on low volume, on low liquidity next week. So there is that tail. I'd say there's a downside tail next week more than an upside tail probably. Yeah.
That's quite interesting. And I know there's a lot of questions here on the JP Morgan positions and this idea of Vanna and Charm. And I think what the takeaway here is ultimately when you're talking about Vanna and Charm, most people were trying to associate, again, a direction with it. And kind of to your point, I think what feels like to me is OPEX is just containing volatility here. And then when Powell, puts his thumb on the scale one way or another, then we may get a small directional tilt. And if Powell is, market friendly and is going to back way off, then yeah, I guess vol is going to come down or going to get the precursor for a rally, but it doesn't seem sort of in the cards or super clear to me outside of OPEX, I guess is what I'm saying. So I think that, again, OPEX will keep volatility contained here. And, if you give edge to downside, then I can agree that things will start to leak out or really move, I guess, after this OPEX. So, OPEX, I think, is like a volatility containment window, right? And then after that, we can kind of, unpin and shift.
But I don't think the reason I think it tails to the downside, though, if I just quickly let me,
please.
Sorry to interject, is just that I feel that there's not really much incentive for Powell to speak friendly to the market, right? Because he's basically just shooting himself in the foot. If he's too bullish in his press conference for the market, if the market reacts too bullishly, it's just undoing the hard work of the hikes, right? Because financial conditions are loosening, and then the wealth effect then spurs inflation, and they don't see inflation keep coming down as quick as they want. So he's got no real incentive to be friendly to the market. So that's what makes me think, whilst I thought this would be a bullish catalyst just because people will have memory from the last CPI, and it's just that is the reaction function, right? If CPI misses, you buy the market. If it's higher, you sell the market. So that was going to happen if we were to get a low CPI. But I just don't think the incentive is there for Powell. Now, having said that, when Powell spoke in an interview a few weeks back, he wasn't overly dovish, and the market decided to rip 3% on it, basically, right?
Yeah.
So maybe he's learned his lesson, and he will be decidedly hawkish in his speak to make sure that doesn't happen again, right? If I'm him, I'm definitely gonna choose my words carefully to not give the market anything to latch onto to the upside, right?
Yeah, I agree with you. I mean, at the end of the day, when you look at equity prices writ large, like they're not that bad. Like the S&P is down, I think, what, about 10% now, something like that. I think the Dow, I haven't checked it recently, but the Dow's like barely down. And so, they're as far as the goal of deflating asset prices goes, like I don't know that it's really been clear that anything that's happened. And even if Powell does pause, like he could just pause. Like, and I think that's quite a bit different from easing. And then the second piece of the equation that comes in, I think, is more of a next year thing. Is there a recession and all these other things? So it doesn't seem to me, it's not obvious, I guess, to your case that there should be a reason to get a substantial, 5 to 10% rally here. So I sort of agree with you. Like if I had to assign edge to something, it's like we're going to kind of like hold fairly tight, I think. But I can see leaking out to the downside as a better option, maybe, than getting some kind of a substantial rally. And lastly, I would just mention on this is that if you look at the positions here, and this is kind of true in the SPX, like there's not much in the way of call positions. This looks at all expirations in terms of, gamma. There's not really much going on above 4,200 at all. And that's even kind of out in time. So the market also doesn't really seem to be positioned for what I would say is a sustained long-term rally. There's not a whole lot left going on the put side either. Like, in general, the positions have been coming down, I think. And so it really does feel like we're wiping the slate largely clean here with the December OPEX. And then I think this, okay, if Powell pauses, then we can all shift away from having to watch every CPI reading, like it is, the most important thing that's ever happened.
Powell's not pausing, man. There's no way he's pausing yet.
I mean I think that's the bull case, right? Is that there's a pause, like when you look at the breakdown. So I'm certainly not forecasting that he's going to do it, and I think that even if he does, still, does that mean the market should rally? So I think that if anything plays into your idea that sort of, my view is we're just going to kind of stay into this tight range, I think, more into year end. But I could agree with the leak to the downside as opposed to the leak to the upside.
What's your trade? What would you do then if that's the view? How would you express that as a trade?
That's a great point. I think that coming out of this OPEX, I want to see how Powell is going to position, right? And so my trade in general is I want to sort of fade whatever moves comes out of OPEX in general. So I personally do not have any positions on right now. I had a CPI trade on, and it feels non-obvious to me about the FOMC. So I've been looking at a couple of calendar spreads because I do want to play this higher implied volatility, and then maybe trying to buy or get long some options more out in January. Because I do think that if I had one takeaway here, it's that the market is pricing in a ton of volatility today and much lower volatility, 30 days out in time. So being short sort of near term and long options, about a month out feels to me like the better case. But I don't feel like I have a lot of edge here, just being honest.
Mm-hmm. Mm-hmm. I think one trade I'm considering is VIX puts against short S&P calls to finance them. So because the sting that I think that the risk was that we were going to have some stupid 5 sigma move to the upside, right? Mm-hmm. We've had a go at that, and it's been faded pretty sharpish. So like I say, I don't think tomorrow's catalyst is the one for a 5 sigma up move, okay, or even a 3 sigma up move. So I think you've kind of got the green light to maybe sell calls again, right? And then maybe you want to wait for the statement to see if there's one final pop or whatever. But so I kind of think I agree. Vol's probably going lower, right? But spot might be going lower as well.
Yeah.
Okay. So it's not entirely sure where the VIX is going to end up, right? Because if Vol's lower but spot's lower, VIX might kind of hang in that low 20s region and be unched, right? So I quite like owning the VIX puts for the scenario where market just dies a death and VIX goes sub 20, which I think is the base case into Christmas. But rather than spending that money on those puts, which aren't exactly cheap, the VIX puts, you sell calls on the S&P to get the premium back, right? And then you have a nice setup where if the market rallies, VIX goes down, calls on the S&P kind of cancel each other out. If the market sells off, you didn't spend any money and both your options go to zero. And if the market kind of sits in the range like what you think is going to happen, VIX gets annihilated and the call's paid for it, right? The VIX puts go up in value and the calls paid for it, basically.
So you have a view then that realized volatility in general is going to come down as well, like let's say over the next quarter?
Well, no, realized volatility can go up on the way down, and I don't give a shit because I've got no exposure on the way down because I didn't spend premium. Market melting down, my calls go out worthless that I'm short. I collect that premium, and the VIX puts that I own go out worthless as well because the VIX goes up, right? Or the VIX doesn't go down. Yeah. So you're taking no tail risk on the left tail. On the right tail, the only way you get screwed is if the market realizes like an animal to the upside and the VIX fails to drop, basically, right?
Yeah.
And I think going into Christmas, that's got to be the lowest delta scenario, right?
Right? The trade makes a lot of sense, and that may be one I'll have to investigate right after this because I do like that idea, and I do agree with you. I think that if you had to take out a scenario here or favor a scenario, it is or bet against one scenario, excuse me, it is that multiple standard deviation rally at this point to the upside. It doesn't seem to make a whole lot of sense. Even if we're transitioning from Powell shifting policy or signaling is going to shift policy or lighten up a little bit going forward, I don't know that the scenario is there to sustain another 5 or 10% rally from here, and then you're basically going to get what S&P back to unchanged, even though rates have shifted substantially, and Powell's sole goal is to bring down unemployment or bring up unemployment and do all these things. It doesn't make a whole lot of sense, and. What is also interesting about this, and it kind of dovetails a little bit, and sorry to keep bringing up Twitter, but I posted up all the charts here. This was the expectations right into CPI, and if you were to look at a chart of OPEX volumes by percentages, like you basically get 0 DTE volume is all concentrated in the next 2 days, right? And then when you look out like a month, like there's no volume taking place in the options market. And this is the area that I think is possibly too cheap. Not obviously 2 years from now, but kind of just January options, right? January options, actually, there's a very big equity expiration in January. And I don't, it's very hard for me to kind of like wrap my mind around this idea, but so much of the volume now is 0 DTE, it's 40 or 50%, depending on what you're looking at. And it seems like the volatility, people expect just unbelievable volatility today and tomorrow. And then after that, it's like nothing. Do you know what I mean? And I don't quite understand that. It's been something that's been really tricky.
This is how I'll rationalize that, right? I don't know if I'm right, but this is how I rationalize it. Okay.
Yeah.
So we've gone into a world where economic data, because central banks have dropped forward guidance. Okay. We've gone into a world where it's all to play for with every single economic data point, and the likes of non-farms and CPI are multi-sigma moving type events, which they never were a few years back, basically, when there was forward guidance, right? For like a decade. Okay. So all of a sudden economic data moves markets. Now, if you're a guy who's using optionality to hedge your book around these key economic data points, well, you don't need to trade an option 1 month out. That you need to trade an option 1 or 2 days out because it costs way less in actual absolute premium. So the amount of basis points you have to put at risk to hedge your adverse outcome is smaller. You get massive leverage to that move, and you get to smooth your P&L and neutralize the risk for that day because you know that the move is coming on that day because the market is so sensitive, right? That's where you get your demand for 1 to 2 day options coming from, right? Because the move is happening on those data points. It's not happening randomly in and around those data points. It's happening on those data points, okay? And then the reason the 1 month stuff is depressed is because there used to be a demand for that 1 month stuff from these guys who are hedging. They don't do that anymore. So that demand's gone away. And the supply of 1 month is all systematic. So like the guys who are overwriting systematically, the guys who are selling puts or variants systematically to earn yield, they're still going, right? Because that, they don't want to be exposed to like the 2 day, they don't want their gamma to be on the moon and be exposed to such a big move on any given day. They want to smooth it out. So they want to sit in that 1 month bucket. So I think it's a function of that kind of change in flows and where the buyers and sellers are, basically. I think that's what's going on.
I mean, that's a nice explanation. I can't find a whole lot of fault with that. It is so it's almost like a function of removing guidance, which I think was originally to remove speculation, has shortened the duration of speculation. Now we've turned it into just kind of a frenetic.
But it doesn't have to be speculation, right? Why does the options market exist as a hedging instrument? People are hedging the data points. They're having fundamental views, right, that are bullish or bearish, and they're saying, well, if I'm wrong on my fundamental view and the data comes out unexpectedly, I want to hedge myself, but I'm happy to only be hedged for a day.
But a lot of the like there's no the positioning is very, very small when you look at the open interest on any given OPEX day, right? And so, whatever the flows come in, and again, I do think it's predominantly, institutional flows coming in. I don't think that it's retail sitting betting, $1 million at a clip on a 0 DTE. So, but you don't see any positioning in the open interest on the 0 DTE options. Even yesterday's positions were really rather small in terms of what was set to expire. And I actually can bring that up in a chart. But I guess what I'm trying to say is that it's a trading instrument, be it hedging or call it speculation, just because someone's betting on a direction. But I don't think it's as much as like I'm going to hedge before the move comes, as opposed to like adjust my risk once the move happens, I guess is what is. So
you're saying people are piling into them after the event, basically.
Yeah, and I think that the more attention is drawn to them, the more speculative it becomes. When I look at the queries that come into SpotGamma about what data is going on and what people want to talk about, and I think that anytime you get that much focus on something, it draws in other players, and now you see. It's really quite interesting too, because a lot of times the volatility seems extremely underpriced when you look at the 0 DT straddles. We've been realizing, 1.5% moves, I think realized vol right now is around like a 25. And, the 0 DT straddle will often be like $20 to $30. And, we've documented this a couple times on Twitter, and you say like, these options are so underpriced. It does not make a whole lot of sense. And then once the market opens, suddenly there's like giant volume comes in, and it drives price in one direction or other. So like normally you would say someone wants to entice selling these options, right? So that they can then run you over into the close. But the problem is like, why would, how do you entice someone into selling that vol if it's too cheap? You see what I'm saying?
Yeah. No, I agree with you. Sometimes those straddles do look quite cheap, and you do wonder why, but it may be, think about it this way, right? Say, the flows that I mentioned, right? The 1 month flows are systematic sellers. Okay. So what does that mean the dealer book looks like? The dealer book is getting hit in 1 month duration type stuff. Okay. So the dealer's long vol, long gamma paying theta. So what's he going to do? He's going to have to lighten the load when there's no catalyst. When there's nothing foreseeable to move the market today, I can't sit there paying $500,000 of theta a day. So I have to sell something. So what do? I sell the shit that I can, which is the front month, or the weeklies, because I don't need to sell many of them to mitigate my decay. So because I know how this works, because I used to run a book with inventory like this, and I used to have these same considerations, right? So if dealers getting hit in 1 month vol all the time, they're going to be a seller of 1 week stuff to fund it a lot of the time, which is going to keep the 1 week stuff actually quite depressed until there's an event when the dealer decides, oh, I'm not going to sell anything right now because I might as well keep my gamma because I think there's a move coming. And on top of that, not only is the dealer not selling the weekly that week, external people come in to actually buy the weekly or the daily that week because they want to own the move. So you go from a situation where the dealer's the supplier of the weekly or the dailies because they've got a book that they're trying to manage the carry on, right? The theta on. But when there's an obvious event that we all know can move the market, the dealer pulls the offer, waits until after the move. Therefore, that offer goes away, and then buyers come in to actually own options for the move. And that's why you get this massive jump in the dailies. And that's that disparity between where the straddle's 30 ticks on a day without an event, and it's 100 ticks on a day with an event, right?
It makes sense, and I guess where my mind goes is that we have record options volumes now. Like every day is a new record, or every month is a new, record in terms of volume. The open interest is not really increasing very much, really at the same clip. So there's not longer term positions being taken in the market. And I think that's a function of the fact that no one's really clear on the upside or downside here. And so I don't think there's a whole lot of edge to want to get into more substantial positions. But it's curious to me that the overall options volume continues to grow so much, and no one is really taking these positions. So it's like, whatever the entity or entities are that are really turning this volume over, and I don't think it's retail. Retail has largely been taken out of the market. Whatever the entity is or entities is really churning the volume over, and it's not self-dealing to me in terms of like, hey, I'm a market maker, I'm just going to trade with myself all day. But there is that sort of feeling about it, right? That if you and me are the only market makers in existence or dealers in existence, and we're just trading faster and faster with each other all day long, right? It's kind of a curious function of the way that the market is happening, or it's a curious function of the way flows are unwinding these days, I guess.
I think algos are getting more sophisticated, right? So like 10 years ago, maybe algos were more futures based, less options based. But now I think, you have strategies out there that are like, for example, systematic condor selling strategies. Okay. And they might have certain embedded stop losses or whatever triggers so it might be a four-legged strategy that is an options trade that is getting stopped out multiple times a day, right? And that is going to be options flow, but it's not going to be open interest from the day before because they're doing it as fresh intraday trades, right? So I reckon there's algos that are growing and doing those type of systematic option trades to try and earn intraday carry and things like that. And then as those trades get stopped out and churned about, that's where you get your blow up in volume, basically.
Yeah, it makes some sense, and I guess I find it very curious. And you added these extra expirations, right? And I think these were actually added after we last talked, where Qs are trading every day and spiders are trading every day now, and that of course is going to increase the volume and increase that. The amount of weight of activity in the shortest days. And I think I wonder if it becomes a liquidity problem at some point, right? If we're all focused in the short term and that's distorting implied volatility in the short term and distorting volatility in the short term, again, does that somehow spiral at some point into longer price moves? I mean, price or bigger price moves over the long term. Essentially, can that break things is what I'm getting at. And I'm still of that mind. And I still think that the more that this stuff gets concentrated, the more churning it distorts short-term volatility. But in the longer term, it causes short-term price dislocations that can be taken advantage of in the longer term. I guess it's kind of, something like this morning's move where we have a blowout in volumes. There's zero DT is only about 50% of volume today. And you have these massive moves with 4 or 5% moves on the day. That used to be a great move over the year, right? S&P tends to go up 8% over the year. Like, this is an unbelievable amount of volatility, and we have unbelievable intraday moves, but ultimately, like, we're not going anywhere. Like, the market hasn't gone anywhere over the last several months. I don't know if I'm working this concept out, I guess, in real time as we're talking, so it's probably not making a ton of sense to people, but it just seems like this volume is I don't want to call it self-dealing because that's not the right term. It's just institutional turnover, be it whoever that is from, and it exacerbates near-term volatility artificially.
Yeah, it's like churning of intraday short-dated options, and it's exacerbating intraday vol, basically, is what we're saying.
Yeah, I mean, it's like, I guess it's elevated jump risk, if you want to call it that. Or, I mean, we didn't used to get these moves again, and it's the liquidity problem and the spreads widening out. But, the moves that we get after these data points are unbelievable, right? But look at today, for example. You get a 200-point, move off the CPI reaction, and then suddenly it all just goes back, to zero. So somebody's holding the bag on that 2% move, right?
But I think it's like back in the day, you had dealers that had bigger risk appetite who could stomach larger swings and didn't need to cut positions instantly. Okay. And then you maybe had the systematics and the algos that were running smaller AUMs, right? So I would say you've had dealer books get smaller
Mm-hmm.
and dealer risk appetite gets smaller, so they don't warehouse as much risk. At the same time, you've had AUM in the systematic community and the algos get bigger, and they're not going to care. They're just going to execute, right? And whatever they print, they print. So I think maybe it's a function of those two things where you're getting these wider moves. Right?
But and as a pool of assets, you know, I mean, do you think that the average fund, the average hedge fund out there is involved in 0DT at all? Like a 0.72 or a Millennium, or, you know, like
so I'd say some would be, yeah, some definitely would be. You know, I definitely know of not just hedge funds. I know of like institutions who use 0DTE to hedge event risk, right?
Yeah.
That's a fact. So there's no reason why hedge funds wouldn't be getting involved in there as well.
Yeah, in the institutional angle, I see, or if you're a dynamic hedger and running a vol book, I see what the advantage, you know, would be to using those products. And again, it just seems to me like the use of options is growing, right? But it really is just segmented to this very, you know, unique 0DTE kind of environment. But I've gone on all that enough here. I think everyone's falling asleep, and Argentina scored, so the excitement there, nice. The Argentina.
Oh yeah, someone put it on the chat.
Yeah, that's really shifting quite a bit. So again, shifting, I guess, to the probabilities here. I'm going to scroll through and look if anyone has any questions for me and Imran. Please let me know. But we're going to shift into, you know, back into this Powell thing. You and I both feel like there's not a whole lot of edge against this expiration tomorrow. I think you're favoring a little bit of a possibly a leak or break down into the end of the year, and I think we may pin a little bit more into the end of the year. But you know, we're both of the view that it's kind of up to Powell here. It's Pat dependent a bit on Powell. Argentina scored again now, 2-0. Wow. So Chase has asked a bunch of questions here. He's a pretty active viewer and commentator of both of our stuff. And so the general question is here, you know, why don't we see more downside? I mean, correct me if I'm wrong here, but I don't think you or I see the, you know, a situation where we get like a limit down, like major, huge drawdown below. You know, you could get some weakness here, but we haven't had that blow off to the downside, huge high correlation move yet. And I don't think that is on the table for any time in the next several months. You know, there's just nothing to suggest that. So, you know, is the fact that no one is looking for that, does that increase the risk of something like that happening?
No, I think what increases the risk of something like that happening is when you've got fragility building down there because people are comfortable going short down there. Mm-hmm. And I don't think people are short a ton of downside. I just don't think they demand any of it because they're not long the market enough, right? I just think they've had plenty of time to get underweight markets and realize how shit the fundamentals are, and the fact that whether recession comes in March or whether it comes in September next year, it's coming. And the labor market's going to go, and the housing market's going to go. So there's not a lot to be cheery about, right? Mm-hmm. And whilst you're super underweight and you're looking at the market, scratching your head, why is the market not going down more? You're not buying puts because you don't even own the market, so you're buying calls instead. So the flattening of skew, and the lack of bid for downside is showing us that market participants don't need protection. But that doesn't mean that they're going out and selling the shit out of downside, because why would you do that when you are bearish as hell with the economy and you see all these cracks appearing? You're not then going to go sell a load of downside tail. You're just going to get out of the market or be short the market and not need that tail anymore. Basically. Right. So I think that's what's going on, right? Which makes me less kind of Armageddon bearish, right?
Yeah, and I agree with you. I mean, this year, you know, this is the SKUDEX here, and if you look at VVIX or a bunch of these other sentiments, there's not been an indicator that through all of everything, you know, everything that's happened, the rapid rise in rates and Russia, and we've gone through this, you know, several times before, that being long vol is not paid off. If you look at some of the tail risk fund, you know, performance this year, it's just not very good, and I think it actually lends this idea that how you want to hedge downside or how you hedged it really could be different, right? If you typically chose more at the money, higher delta puts this year, you've done probably a whole lot better with your hedges than trying to buy Vega. Basically, just that tail risk stuff has not really paid off. And what is the catalyst for that to pay off? And so to get this controlled descent to the downside, I think it is, we're likely to get more of the same, in my view, if we start to move down, where, we grind down, we get these violent short cover rallies, and we kind of just, drift back lower. To me, there's just not much more to change from that. And I think what you're basically alluding to before is like, there's a lot of reasons just to not own stocks at all, or get out of stocks. There's not a lot of reason necessarily to buy them. And so if you're not owning a lot of stocks, then why are you even going to hedge them now? Like, what's there to hedge, right? Exactly. The bigger predominant put flows are probably going to be speculative, unless there's some type of credit event or credit risks, increases substantially, in which case you may get more put buyers, because they need to hedge those positions. So what's the impetus to add a whole lot of puts to your book, I guess is how I would summarize that. So, but
it'll be one of those, and rates. Think about it, right? Rates are rising, right? Mm-hmm. So there is yield to be had in owning short-term treasuries now, right? So it's kind of, there's no incentive to go and smash out a load of downside puts to earn premium when I can just stick some money in a 4% risk-free rate, right? So yeah. So that's another reason why I don't think you're getting loads of people selling downside vol and creating this massive fragility to the downside.
Yeah. And I brought up this chart. I mean, the Dow here is in orange, and the boomers are winning with their Dow positions.
Yeah, that's been a pretty incredible outperformance, isn't it?
It's only down 5% on the year. As of this moment, it looks like the S&P is down about 15%. And I bring this chart up because if there was, again, real panic, you would get a correlation of 1 and all stocks would just be getting pounded, right? And this is really not, I think there's been a couple of clips this year where everything really seemed to sell pretty hard. But, at least what's been happening the second half of the year, it's been kind of a stock picker's market. Like, if you bought McDonald's, if you bought some of these other more classic dividend paying names with good cash flows, like those stocks have done all right. This has not been a writ large, just sell everything I possibly can. And in some ways you say, well, Powell maybe had done his job. Like the stuff that's most speculative has gotten pounded, the ARK basket. Tech is underperforming, but the classic, quality names are doing pretty well. And so, again, this is not a fearful market, right? This is an asset allocation repricing type of environment. And so
rotation.
Yeah. And I still think that the PE of the S&P, I think, is around 18 or 20, kind of in that neighborhood. We're moving at 5% moves in the S&P on a daily basis here. So I don't know. But I think the more fair value, as people have been talking about, is in the S&P down around this 3,500 area, in terms of where value guys may really come in and say, hey, the S&P just as a whole pays better here. There's a lot of, you look at the dividend rate in the S&P versus what you can get in the 10-year or something else, and how do you justify the risk of equities? And none of it is really a blinking like green light, hey, I got to get in here at this level. And I think still this February, pre-COVID high, I think it makes a lot more sense to get more long-term buyers in, right? Down and around these levels. That to me seems to make more sense. And if we do visit that, it's going to be a grind down. It's not going to be a get there in 2 days kind of move.
Yeah, no, I don't disagree. I mean, Macro Alf does some good work there in terms of figuring out what his fair value is, looking at equity risk premium versus real yield differential, where real yields are, and that type of analysis. Yeah, so he puts fair value roughly around 35, 36 as well. And he says if you're up at 40, if you're up at 4150, 4200, you're kind of at blue sky valuations, right? It's like, what the hell are you doing up there? So that's kind of your trading range, right? Like, it doesn't have to be a massive breakout either way, right? But like, if you're near the top of that 4100, 4150 area, you probably want to bias a bit short. And if you're anywhere near 3600, you probably want to be more neutral, maybe even a bit long, right? And that's, trading that range is kind of working right now. And I don't see a great reason to think otherwise for the short term. Yeah,
I agree with you. And I had the Qs on here, and you can see just how much underperformance that has been on a relative basis here. It's pretty stark. So you and I are coming up. We got another call here in about 10 minutes. So we got to start to sort of wrap this up. I want to mention one thing from an administrative perspective. We launched a spreadsheet. If everyone is interested, it details the largest options positions on the single stock side that are expiring on this Friday. That is in the description. That is in the YouTube description. We'll put that on Twitter shortly. But if you click that, you can download a spreadsheet that details how big all the gamma and delta positions are for this upcoming OPEX. Imran, I want to thank you very much for your time and listen to my diatribe on my strange little zero DT.
No, always good to chat to you, mate. Always good.
Can you enjoy it? Yeah, can you please let everyone know how to get a hold of you? Your Twitter's awesome. Your videos don't get enough views on there. So hopefully that volume pumps up because you deserve it, buddy.
Thanks, man.
Yeah, so sure. Let people know how to get a hold of you.
Yeah, so I'm options_insight on Twitter. And, you know, I put daily videos out there on my YouTube channel. And I'm basically looking at my cross-asset volatility dashboard, screening what's going on in equity vol, commodity vol, FX, rates, and sectors. And the stuff, I don't look at every single asset under the sun, but I look at a collection of assets. And I kind of try to get a read on where the value is in vol space, which buying stuff, selling stuff, cross-asset. And I try and suggest, for my subscribers, I try and suggest trade ideas that make sense around what I'm seeing in vol. And I do express those views myself. And I put on trades myself, and I kind of share that with subscribers so they can see what's going on. And really, it's not about copying my trades. It's about learning how I think about it and how I approach it to then apply that to your own trading and your own style, right? That's what it's all about. It's really an education service, but it's showing you how it's done, and so you can learn alongside.
Yeah, and I think that's key. I mean, we try to do the same thing here, education wrapped in market views. And so I would just leave it like this over the next few days. You brought up this trade, selling upside calls to buy VIX puts. I like that trade. I think that expresses both of our views pretty well. I'm a little more neutral and average, a little more neutral, lower volatility over the next 2 weeks and the end of the year. And you think we may kind of leak out a little bit to the downside. And so we're both on the same page of not looking for upside, which likely means the S&P goes up 10% in the next 2 weeks. So
good point. Good point.
So again, thank you very much, Imran. And we'll be talking to you in a month, 2023.
Great, man. Take